I'm Eli, this is Jack, and this is Brendan, and we're going to brief you on the Accounting Standards Update 2016-13 on financial instruments credit losses.
So some things we'll be going over with you, some things you can take away from the presentation. First, we're going to outline the current guidance and the reason that the new guidance was needed to come out, some changes that need to be made. Second, we're going to identify some significant differences and challenges related to assets measured at amortized cost, mainly debt securities. And then thirdly, we're going to identify significant differences and changes related to available for sale debt securities, mainly those available for sale debt securities and also receivables as well.
All right, so just to start out here, we're going to give you a little background information of kind of where this came from and why it was needed and what was going on, so you can kind of put the new standard in context a little better. This is a headline from April of 2007, top U.S. lender in Chapter 11 bankruptcy move. This was New Century Financial. This is obviously starting the financial crisis that we now know so well today. Here's another headline. Another top U.S. lender risks bankruptcy. This was countrywide. And here's a chart real quick of the Dow Jones Industrial Average. You can see from 2006 to 2008, there's a significant decline, obviously, with all the pressures from this financial crisis. Here's a graph. It shows the business Chapter 11 bankruptcy filings over time. In that top graph, you can see there's a huge spike related to the financial crisis. Furthermore, you can see the chart of U.S. bank failures by year. Once again, you can see that same spike that we saw with the bankruptcy filings to the bank failures. So what does this mean for other preparers in the accounting world in general? It had a lot of effects on firms, and this was something that stressed the system, and a lot of new regulation was a result of that because we really got to see where there were weaknesses. So one of the effects was with all these bankruptcies and defaults, it started to affect all the financial instruments of systems, whether that be debt from other firms, whether it be receivables or insurance contracts, so on and so forth. Pretty much any financial commitment that was between two firms was now suddenly questioned if it was going to withstand all this financial stress. So one thing that became evident was there was a clear gap between the users and preparers of financial statements. Analysts anticipated credit losses as the financial crisis started to become more prominent and rear its ugly head. The preparers as well started to anticipate these credit losses as they're aware of these macroeconomic trends happening and the effects that they were going to have on their businesses and, as I discussed before, debt from other firms and receivables and other sorts of financial obligations. However, in a lot of cases, no credit losses were recognized at this point when analysts were anticipating them and preparers were anticipating them. And this obviously kind of creates a problem. But no losses were recognized because it didn't meet the current gap threshold to recognize these credit losses that they were anticipating. So the analysts were attempting to model these losses with little relevant or reliable information. It was just guesswork, and obviously that does not fulfill the purpose of accounting and issuing financial statements to provide this relevant, useful information. So there was a clear failure there. So as I discussed before, this created a regulatory response. The FASB and ISAB realized this is obviously a clear problem. They need to attempt to fix this in some way. And so they created the Financial Crisis Advisory Group, whose main tasks was to identify areas of weakness that became visible through this financial crisis that were not visible before. So the Financial Crisis Advisory Group identified the recognition of credit losses as one of these areas due to the reasons that I described in the last slide. They noted that current GAAP resulted in delayed recognition of the losses, and this overstated the assets of many firms and was a clear problem. So now we're going to talk about some current gaps to give you a little context of where the new standard comes from.
So the way the current gap treats recognition of credit losses with receivables, currently ASC 310 covers a lot of this. It requires recognition of a loss when two criteria are met. The first one is the available information indicates that it's probable that an asset has been impaired. And then the second criteria is that amount of loss can be reasonably estimated. And then they're only measured when these probability thresholds were met. So that's where a lot of the problems were coming from during the first financial crisis. A lot of analysts could see these credit losses were expected, but since they didn't meet the probability threshold, they weren't being recorded. And then another standard says that losses from uncollectible receivables should be accrued when both of the conditions are met. And then the considerations should be related to individual receivables. Only when the conditions are met, you should make your accruals, even though they may not be identifiable. The current guidance doesn't specify how to determine that losses are probable. That's another thing that we'll talk about with the new standard. The new standard provides a lot more guidance on for characteristics that you're supposed to use to identify losses. And then the three ranges to identify what's probable or not is you have probable that the events are likely to occur. You have possible that they're more than remote but less than likely, and then remote that the chance is slight. So you're not looking at just expected. You're having to have almost certainty that an event is to occur before you can record it. And some final things on current gap receivables. A lot of this requires judgment and practice, and like I said, probable doesn't mean virtually certain, but it is a higher likelihood than more likely than not, which provides a lot of judgment, but also creates a lot of expectations that, although they're not probable, a lot of people think that they should be recorded on the financials.
So now we're just going to talk about held to maturity debt securities, the current gap for it. So investments in debt securities that are held to maturity are measured at amortized cost currently. An investment is impaired if the fair value of the investment is less than its cost. And some indicators of this impairment that the guidance goes on to specify here from topic 320, significant deterioration in earnings performance, credit rating, asset quality, or business prospects. These are all things that would have been seen or started to be seen in the financial crisis, as you can see. Adverse change in regulatory, economic, technological environment, an adverse change in the general market condition, or also a bona fide offer to purchase, an offer by the investee to sell, factors that raise significant concerns about the entity's ability to continue as a going concern, like negative cash flows, working capital deficiencies, non-compliance with statutory requirements or debt covenants are all kind of large, obvious indicators that there's some sort of impairment here. And the guidance goes on to specify that if an entity is more likely than not to be required to sell the security before the recovery of the full amortized cost basis, then an other than temporary impairment is considered to have occurred. And this impairment is if the present value of cash flows expected to be collected is less than the amortized cost basis. And it goes on to describe this impairment synonymous with a credit loss, just as we had seen with the receivables. So And also, they mention further down in the guidance that in determining whether this credit loss exists, an entity shall use its best estimate of the present value of cash flows that they expect to receive from the debt security. So once again, you can see there's a lot of judgment involved with this. As they say, best estimate. It's not a sure thing. And also then it refers for more information on how to properly calculate this credit loss. It references you back to topic 310, which is the receivables. So that's where the probable threshold is brought back in for held-to-maturity debt securities. So everything that we discussed with the receivable is probable that this loss will incur. This threshold is tied back in with the held-to-maturity debt securities. And there's one thing I thought that was interesting here, this quote. FASB even goes on to say itself, it is usually difficult, even with hindsight, to identify a single event or particular that made a particular loan uncollectible. However, the concept in GAAP is that impairment of receivables shall be recognized when, based on all the available information, it is probable that the loss has been incurred. So they're kind of admitting that this is a tough subject, and a subject where there's a lot of gray area, because they say it's difficult. And obviously this comes as no surprise. It's just a little bit almost funny to kind of see it spelled out explicitly by FASB. So now we're going to talk about available for sale debt securities, which are accounted for in a little different manner. Debt securities that are classified as available for sale are going to be measured subsequently at the fair value. So we're going to have changes in the amount that's shown on the books here. And the unrecognized holding gains and losses will be excluded from earnings, and they're going to be recorded in other comprehensive income currently. This is just an example of how an entry would look if there was a gain on a security, or in the case of a credit loss, you would have a loss. So there would be a debit to a loss, other comprehensive income account, and a credit to this unrealized holding gain or loss. So, and then once again, it relates back to the probable threshold when you're determining the amount of a credit loss to recognize on these available for sale debt securities. So it is very similar, all three of them, in how we approach it currently in GAAP.
We're going to show you a little bit of a video that'll outline the process under the new standard before we actually get into it. So this video outlines the five-step process that the new standard goes into under some of these assets that are measured at the amortized cost. So here you go.
FASB has issued its final accounting standards update on credit losses for financial instruments. This will have a significant impact on your current processes, as this is the largest accounting change in banking history. The following 5 steps can help to ensure that your implementation plan is well documented and supported. The first step, determining proper pool segmentation, requires that each pool exhibit similar risk characteristics. Additionally, these pools should be as granular as possible while maintaining statistical relevance. Management should also evaluate these pools on a periodic basis to make sure they continue to exhibit similar risk characteristics. Step 2, calculating the life of each pool. This is a critical component of each methodology. Management will have more flexibility the more that they understand the life of each pool. Prepayment speeds and mortality rates are tools that management can use to calculate the life of each segment. Step 3, calculating your historical loss experience. This requires running multiple methodologies on each pool. Doing so will yield more accurate results and enhance your documentation. Additionally, running your historical loss experience over an economic cycle requires an iterative process over multiple periods. The next step, step 4, adjusting your historical loss experience for current and forecasted conditions. This requires an understanding of how your portfolio has performed over time relative to external and internal information. Management may revert to historical loss experience alone when a reasonable and supportable forecast cannot be created. Step 5, your documentation and disclosures will require more effort. Also, begin calculating your vintage disclosure today to ensure that your data and processes are adequate to meet the requirements. Begin now. Determine how you plan to execute these 5 steps while maintaining transparency, flexibility, and minimizing risk. These are critical components of your decision framework heading into CECL implementation.
As you can see, that video outlined what we're going to be explaining in the next couple of slides. But first, we want to give you a little bit of an overview of the new standard. So the objective of this new standard is to provide users with more useful, relevant information about credit losses, especially with reference to what happened in the financial crisis when filers couldn't actually report losses even though they expected them to happen. The effective fiscal years for this update will start December 15th, 2019 for SEC filers. So fiscal year starting after December 15, 2019, and who are SEC filers will have to implement this. And for everybody else, it's December 15th, 2020 for all other preparers. This update will allow preparers to recognize credit losses when they're expected instead of probable, which is one of the big issues that I just mentioned and Brendan mentioned earlier as far as the financial crisis and giving users more relevant information. It replaces the current incurred loss impairment methodology with the expected credit loss model. So we're going to talk about financial assets measured at amortized cost, and that was the 5-step process the video illustrated just a few minutes ago. The scope of this amendment, this specific amendment, is financial assets measured at amortized costs, held to maturity securities, revenue transaction receivables, and reinsurance receivables. The initial measurement is to pool the assets with similar risk characteristics. And any is supposed to report in net income the amount that is, as a credit loss expense, the amount necessary to adjust the allowance for credit losses. Creation of an allowance for credit losses account is deducted from the amortized cost basis of the financial asset to present that. We're gonna have to pause. I can't see. Sorry guys, I can't see that. So here's just an overview of exactly what the new standard is about. The objective is to provide more useful information about credit losses. So one of the problems that filers ran into was not being able to actually record losses when they expected them, and it gave users kind of an incorrect idea of what was going on in the markets, and this is trying to remedy that wrong a little bit. It's going to be effective fiscal year December 15th, 2019. Anybody after that, SEC filers will have to implement this guidance. And for everybody else, all other preparers, it's December 15th, 2020, any filers after that. This new standard will allow preparers to recognize losses when they're expected instead of probable, which I just mentioned a second ago and which Brendan talked about earlier. It replaces the current incurred loss impairment methodology with the current in the standard expected credit losses model. There we go. Okay, so the scope of this new standard is financial assets measured at amortized cost, held to maturity securities, revenue transactions receivables, and reinsurance receivables. So, as the video talked about earlier, there's a 5-step process to initially measure this. The first step is to pool assets with similar risk characteristics. One of the first paragraphs in ASU 26-2030 says that everything will flow through that is relevant to this to net income. So it will not flow through to OCI, and that you have to create an allowance for credit losses, which is a valuation account, and you'll deduct that from the amortized cost basis of the financial asset to present the net amount you expect to be collected on the financial asset. A continuation of step one is that the entity should measure the expected credit losses of the financial assets on this pool basis, and if it doesn't, if some of these assets don't share similar risk characteristics, you have to account for them completely separately. So you try to pool these assets that have similar risk together, but if you have one that is significantly different risk-wise, then you have to just simply account for it separately outside of the pool basis. And some examples of the risk characteristics pool include term, industry, credit ratings, scores, and size. So that will move us on into the second step, which is to identify appropriate loss measurement methods for each pool. And there's no specific guidance that is given by this. You don't have to choose one of the specific methods that the FASB gives you under this new ASU, but they do suggest that you use discounted cash flows method, loss rate, probability of default, and other methods that use aging schedules, but they don't order you to use any of those specific methods. Step 3 is to identify historical loss experience on each pool. So the FASB says historical credit loss experience of financial assets with similar risk characteristics generally provide a basis for an entity's assessment of expected credit losses. So they want you to look at the history of similar or the same assets when determining exactly what you should do. And that'll move us into step 4. Adjust the historical loss experience to reflect current conditions and reasonable and supportable forecasts. So the FASB says when an entity uses this historical loss information, they should consider the need to adjust the information to reflect what management expects, what they expect the current conditions and reasonable forecasts, how they're going to differ based on what historical data has told them. So you don't have to focus solely on the historical data. You want the SEC, the FASB wants you to adjust it based on what you expect. So that will move us to subsequent measurement, and what you have to do with regard to subsequent measurement is just go back through that process in order to subsequently measure these financial assets.
So I'll talk a little bit about what the new standard says about available for sale debt securities. So an entity shall determine whether a decline in fair value before the amortized cost basis has resulted from a credit loss. So what that's saying is you actually determine a fair value for your securities and apply that against the cost basis for which you actually paid for what the asset is actually on the books as. And then you should record your impairment related to the credit losses through an allowance account for your credit losses. And then that allowance is actually going to be limited to the difference in amortized cost over the fair value. And then entities should reevaluate this impairment at each interim reporting date to make sure that it's up to date and that your allowance is properly reflecting the fair value of the asset. And then this expense related to the losses in the allowance account are going to flow through to other comprehensive income. And then Brent's going to talk a little bit about the challenges.
So, as with any change in accounting guidance, there's obviously some significant challenges. So we're going to talk about that and how effective this is in addressing the original concerns about this gap between when losses are actually recognized in the statements and when users and preparers began to expect them and feel that they would occur. So one of the largest challenges is the fact, and this is highlighted by the fact through comment letters, and a summary of all the comment letters. They received hundreds of comment letters on this through the whole standard setting process. It's clear a majority of users prefer that a model be used where all expected credit losses are recognized and there's no threshold like the current probable threshold for recognition. So this is kind of a very conservative approach, but that's what analysts would like to see so they have a better idea of the risk associated with the assets on a firm's books, and it makes sense. However, on the other side of it, you have a majority of preparers that have all expressed that they would like to only recognize some of the expected credit losses or have a threshold for the recognition of credit losses. So you can see that there's a clear gap in the wants of the two parties, the users and the preparers, which, once again, this is no surprise. This is something that's probably seen on a lot of different accounting issues. So the problem is that management, as evidenced by their comment letters, they have an incentive because of firm performance and just a natural inclination to maybe not recognize all these credit losses. And this new standard attempts to combat this and bring it more in line with what users would like. But there's a lot of judgment involved in this, and when they have this potential inclination in the back of their head, and it's a gray area where the FASB doesn't specify how the losses should be calculated and uses a lot of broad terminology, there still are scenarios where this, not circumvented, but will not be as effective as someone idealistically would like it to be in recognition of all these expected credit losses as in line with what the users would want. So, like I said, it's still based on an evaluation of a lot of similar criteria that were evaluated with the current standard. A lot of things have stayed the same in the evaluation. It's just that probable threshold is gone. But it also, the methods left to be computed, the methods used to compute the actual loss, as Eli has mentioned, and I think Jack mentioned it too, they're stated. There's a bunch that are mentioned, hey, this would be an acceptable method, but none of them are ordered. So it's up to the firm's judgment as to what one they're going to use, which once again, who's to say someone might not use one that, oh, this is going to be a little bit better for what we believe as opposed to the other one. There's kind of a lot of gray area in that. And there's a variety of factors to be considered. So there's the potential here for preparers to only maybe evaluate or weigh the opinion of some factors or evidence from some factors more heavily than others. Some that confirm their suggestion and what they want to do as opposed to the other and ignore that and find evidence to disprove some of that. With a large subjective thing here, there's more opportunity for them to kind of pick and choose in that respect. And this also kind of hurts the comparability across industries and across different preparers because some people may be recognizing credit losses on some factors, while another industry may be using other factors, so it may be hard to compare. And as the FASB has recognized and even said in the current guidance that these are all estimates, and the estimates don't necessarily transition equally into what actually occurs. It's a best estimate, and at the end of the day, it's not perfect. So where you have different estimates from different preparers, how does that affect users in their comparison of the quality of a preparer if they're evaluating as a potential investment? It's not apples to apples for credit losses across all these preparers. And also another area where there's still some question is the selection of the pooled assets. Once again, anytime there's a place where management is going to be able to exercise their judgment and something's not ordered by the FASB, there's questions, I guess, and it may be hard to compare across preparers. And also, pooled assets that they pick may not become representative of what's actually going on. There can be some issues with that. So that's another thing that is kind of opened up by this new standard as a potential challenge that doesn't really leave you with a square answer as to, hey, this is going to be a better solution than the one we had in the past was. And now Eli's going to talk about an example from the guide to just kind of walk you through one where there's a write-off and then a recovery of some of that amount.
So I'll work through this case, this little example with you. In this example, Bank K currently evaluates its loan to entity L on an individual basis because entity L is 90 days past due on its loan payments, and the loan no longer exhibits similar risk characteristics with other loans in the portfolio. So like I talked about earlier, they have to split out this loan because it doesn't exhibit similar risk characteristics to other pooled assets. So they have to evaluate it on its own merit because of the risk characteristics involved. At the end of December 31st, 20x3, the amortized cost basis for entity L's loan is $500,000 with an allowance for credit losses of $375,000. So that will leave it with, which will be important, $125,000 carrying value. During the first quarter of 2014, 20x4, entity L issues a press release stating that it is filing for bankruptcy. Bank K determines that the $500,000 loan made to entity L is uncollectible. So in response to this, Bank K measures a full credit loss on the loan to entity L and writes off its entire loan balance in accordance with the new ASU. So what it does is it will debit credit loss expense for that $125,000 carrying value, or credit that, and debit allowance for credit losses for that same amount. So it brings the carrying value to zero. And right after that, they will credit the allowance for credit losses, or debit the allowance for credit losses, and do the same thing with the loan receivable. And so they'll take it completely off the books, essentially. They will remove the loan receivable and the allowance completely off the books because they don't expect to receive anything else from this. And then during March of 20x6, so about a year later, Bank K receives a partial payment of $50,000 from entity L for the loan previously written off. Upon receipt of the payment, Bank K recognizes the recovery in accordance with the paragraph in the new standard, and they will use the following entry. They'll debit cash for the receiving of that cash, and they'll credit the allowance. And there are multiple ways to do this, as we'll see in a minute. They don't have to credit the allowance account for that $50,000. For its March 31st, 20x6 financial statements, Bank K estimates the expected credit losses on its financial assets and determines that the current estimate is consistent with the estimate at the end of the previous reporting period. During the period, Bank K does not report any change to its allowance for credit losses account other than the recovery of the loan to entity L. So not much has changed. They've received that $50,000 and their estimates are consistent. There aren't any changes between the receiving of that $50,000 and now. To adjust the allowance for credit losses to reflect the current estimate, Bank K reports the following for its quarterly financial statements. So they debit the allowance for credit losses and they credit the credit loss expense. So they remove the allowance from their books and just lessen the loss so that they can take it off. But as I said, that's not the only way they can do it. Alternatively, Bank K could have recorded the recovery directly as a reduction of credit loss expense instead of actually putting the allowance account back onto the books. So there are two ways that you can do that under the new standard. Just another complexity to look out for. And so we'll transition into some questions, and Jack is going to go through those with you.
Yeah, so I got 5 multiple choice questions to see how well you guys learned the material today. We'll start off the first question. We'll start off pretty simple. What fiscal year start date does the standard go into effect for SEC filers? A, December 15th, 2020, B, December 31st, 2020, C, December 15th, 2019, D, December 15th, 2018, or E, January 1st, 2019. Want to call on somebody? You. Yeah, you got that right. It's C, December 15th, 2019. Question number 2. We'll get a little harder here. Where will the credit losses for debt securities held to maturity be recorded under the new standard? Is it A, equity, B, net income, or C, other comprehensive income?
Is it C, other comprehensive income?
That's right,
No,
Brandon.
I'm sorry. It's actually B, net income. So we'll move on to question number 3, almost done. When should credit losses be recognized under the new standard? This is a question to see how well you know the threshold for the new standard. Is it A, probable, B, more than likely, C, behind a probable doubt, or D, expected?
I'm going to say D, expected on that one.
Oh, that's correct. It's D, expected. So they took away that probable threshold, and as soon as any entity expects that they might not recover the full amount, then they can go ahead and record that credit loss. Question number 4. What method should an entity use to measure credit losses according to the new standard? Is it A, discounted cash flow, B, loss rate, C, probable default, D, roll rate, or E, aging schedule, or F, there's no required method? I accidentally put that answer out.
Trick question. No required method.
Yep, that's right. There's no required method. You can use any of these methods, but again, you have to disclose the way you come to your estimates and what methods you're using. And then the last question, what is not specifically named as a criteria when establishing a pool of assets for the new standard? Is it A, variance, B, industry, C, term, D, credit score or credit ratings, and E, size?
I'm going to guess A, variance.
Yep, A, variance is correct. You also can use a bunch of other criteria, including geographical location, but variance is definitely not one of them. So that's all we have for you. Thanks for listening. Hope you learned something, and see you next time.
So 17